Hello, everyone. Thank you so much for taking the time out from your busy schedule and joining in today. With us, we have special guest, Mr. Anshul. He heads the portfolio management team at Kotak Mutual Fund, and it's a separate vertical for PMS at Kotak Mutual Fund, which is headed by Mr. Anshul Saigal. And so Anshul brings about more than 2 decades of experience in the capital markets, and he's been with Kotak for over a decade. It's been, to be very precise, more than 14 years, 14 long years he's been working with the organization, and kind of has been instrumental in terms of shaping up the investment philosophies of the PMS at an organization level, and also taken this to the next level. And before joining Kotak, which was 14 years back, he has worked with large organization like JP Morgan and ICICI, where he did complete analysis of equities, both for equities also on the credit side. So he's been very passionate about value investing, and I heard him couple of times talking about the safety of margin. And we thought, why not, we'll have an opportunity to invite him here and read his mind, understand what is value investing, how does it work, and he's we'll also try and understand, especially how to deal with these volatile times, because markets are now very volatile, and I'm sure all of you are curious to know that how does Anshul deals with these kind of situations, and how does he manage the portfolio. So firstly, Anshul, thank you so much for accepting our request and taking the time out from your busy schedule and joining the call here.
It's an absolute pleasure. Thanks, Vikas, for having me and for inviting me. It's a pleasure to be speaking with you and with the audience.
All right, thank you. So as I can see, there are 89 investors who have joined this call, and I think all of them are curious to know your views on the market. So before we come to the value investing and margin of safety and understand your investment philosophy, let me begin the call by asking you first question. Where are we headed in terms of the markets? Over to you.
Uh, Vikas, in our judgment, it is a simple equation that if the cost of funds is low, the multiples that companies get is high, and if cost of funds goes up, the multiples that companies get is relatively lower. So this inverse trade-off is what drives the market. Now, there is nuance to this. It's not an immediate sort of an impact that cost of funds has on multiples, and also the nuances in understanding where cost of funds will be in the future. Now, if you go back to the period 2003 to 7, you saw crude prices go from 20 to 150 odd, 147 or thereabouts. And inflation also in that period kept going up. And US Fed funds rate went from 1% to as high as 6% in that period. So there was a gradual increase in US Fed funds rate in line with inflation. And despite that, in that period, you saw the Indian equity markets move from 3,000 to 21,000 at the peak. So a 7 times rise in the Indian equity markets, despite a Fed funds rate rise over a period of time. Now, what that means is that the rise in interest rates was factored in into numbers, and growth was so strong that the equity markets kept rising. However, uh, there are times when you have seen that if there is a sharp rise in interest rates, then that impacts equity prices adversely. Take the case of 2018. In that one year, you saw about four increases in interest rates, up about 1% in US Fed funds rate. And while the large caps held on globally, but the small and mid caps, as a result of this increase in interest rates, were impacted meaningfully. Now, we are at a time where there are multiple sort of uncertainties, and one certainty that is there is that interest rates are going up because inflation is high. That chart is quite visible that inflation is high, not only in India but globally. And as a result of that, interest rates are going to move up. When that happens, there will be, of course, jitters in the markets because the markets have, over the last 2 years, priced in significant upside and growth, which is already priced in into the markets. And so a sort of upward move in interest rates, there is no room in multiples, stock price to earnings multiples, for them to go up. And if that is the case, then the only alternative that remains is either these multiples will remain here for a period of time, means there is a time correction, or in certain cases there will be a price correction. We have seen some of the marquee names in the market correct as a result of this expectation. And so, this is a cleanup process of the markets, and it is good for the markets that this cleanup process is already underway. Maybe there is some more time for this to go on. But there will be volatility in the markets in the near future, 2, 3, 4 months, and that volatility will create a base for the next leg of move. And India in the long term is poised for significant up moves, let alone the near term volatility. Being leveraged to that upside is most important, and for doing that you have to bear volatility. We are positive long term, we are neutral sort of medium term, short term. That's how people should build in their expectations. And also in times of volatility, it is a time to actually build portfolios because you get the right prices for the long term, and gradually putting monies to use in times of volatility is the best strategy.
So it reminds me one good statement said that you should be greedy when others are fearful, and you should be fearful when others are greedy. And as you rightly mentioned, that it's a good time to accumulate equities as much as you can based on the liquidity. But couple of subsequent questions, or followed up questions on what you mentioned. So two things, Anshul. One is that, do you think that BJP government was not capable enough, or maybe I would say witnessing this inflation issue for the first time, unlike UPA 1 or 2 who dealt with this in the history by 10, 20 long years? You think that is a concern because the situation has gone out of control in terms of inflation?
Actually, let's look at numbers. If you look at the CPI today, CPI is about 7.5% roughly, right? And everything and anything that you could think of that is a concern has played out. Crude has gone where it has, steel prices, food prices, everything has moved up, yet inflation is 7.5. Let's look at the period 2009 to 14. Average inflation rate, CPI rate in that time was 10.5%. And none of the concerns that are existing globally today existed then. If you looked at the inflation levels in the Western world around that time, inflation levels were 2-3%, and India was 10.5%. Today, after 40 years, US inflation rate is in fact higher than India's. US is 8.6, India is 7.5. So essentially, actually in this case, lack of experience has worked for them, because in the context of the world, they have performed far better, and in the context of India's own history, they have performed very well. We are, I mean, I can only say this, having some knowledge of this subject, that we are fortunate to have the kind of inflation that we have today. Otherwise, and it is because of deft management of inflation and procurement of goods that this is happening. Otherwise, this number could have blown out of control.
Yeah, the other thing which which we are curious to know from you, Anshul, because you track the economy so closely, both as an individual and at an organization level under the able guidance of Nilesh Bhai. You think that inflation is equally important for the growth of the economy?
So inflation is definitely, I mean, it is a signal that growth is happening, no doubt about it. Because let's take an example of US as we stand today. The biggest worry in US today is wage inflation. Wage inflation happens when there is enough employment. So having so much employment is also something that is a cause for concern on the inflation side. Correct? And so inflation is a sign that growth is happening. Only thing is that inflation should not be out of control. It should remain within the bounds of what central banks have set, limits that central banks have set for themselves. In US, the limit is 2% and inflation rate is 8.6. So inflation has gone far beyond what the central bank had expected, in terms of a read on inflation. Now that causes concern. As long as it is within a accepted range, inflation is fine. And so inflation is good. It is an indicator of growth, but inflation beyond the expected levels is something that one should worry about.
Okay. So now coming back to our topic, and before we come to the PMS bit, if you could just take us through what is really value investing and how does it help the investor community to safeguard their portfolio, because you believe in preserving the capital first and then generating the risk adjusted returns, I would say, consistently. So if you could throw some more lights on your thought process.
Um, Value investing is, let me simplify that by looking at personal investments, right? Now we have the option of investing in, say, a fixed deposit or say a savings bank account at say 3.5%, 4%. But we want higher return on our capital, so we look at fixed deposits where we get whatever 6-7%. But we want higher returns than that, so we look at bonds where in certain bonds, low rated bonds, we get 9-10%. But we still want higher returns, so we look at risk assets. And risk as, not that bonds and debt is not a risk asset, but it is relatively low risk. Then we go to equities where we are looking at 15-16% returns on our investment. Now, transpose this onto companies. Companies, if I start a company, I put my capital in a company, and I have all these options to invest my capital: fixed deposit, savings bank account, other equities. But I invest behind a business because I want greater returns than my fixed deposit, other equities, etc., from the business that I'm investing in. For the headache that I'm taking daily, giving money, collecting money, building a product, selling it in the market, finding a market for it, it's a very big pain. So, on that, I want greater returns than my personal investments, which means that if I'm making 15-16% personally, then I want 20% return on my business, correct? Now, that business which generates 20% on my capital, it is return on capital on that business, which I'm getting 20%. That business is a good business. If that business was to generate 10% return, then for the headache that I'm taking to set up that business, it is not worth it. I can put my money in a fixed deposit or a double A rated bond and make that kind of money without any headache. So why should I set up that business, or why should I invest in that business? So first thing, I want to invest in a quality business. Second thing is that even diamonds have value. Now, if a diamond is worth 5 crore and it is the best looking diamond, most pristine diamond, I don't want to pay 10 crores for it. Now, Bannerghatta is a great place in Pune. If a bungalow is available for 10 crores, just because it is Bannerghatta, I will not pay 20 crores for it. There is a value to that bungalow, I will pay only 10 crores. Similarly, these businesses, which are quality businesses, which are available in the markets, I want to pay a reasonable price for these businesses. I don't want to overpay for them. And that really is value investing, where you are paying reasonable value for quality businesses with the understanding that you have at the time of investment that you will not on this investment lose money, but over a period of time you will make money. Now the question arises, what will make you make money? How will you make money on that investment? That making of money on an investment, when you are investing in equities, just like when you are investing in your own business, you are investing in that business for growth. You want growth. And same way, when you're investing in an equity, you want growth in the business of that company. And if that growth comes in, and that growth is value accretive, which means that on every rupee of growth that that company generates, that rupee is available to you as an investor, rather than that rupee needing to be reinvested in the business. If that rupee is available to you, then that is a good business, because the business throws capital for shareholders. And so, as a equity investor, I am looking for businesses which are quality, growing, and are available to me at reasonable prices. Many times, most times in fact, such businesses which are quality, growing, and available at real reasonable prices are a misnomer. That such an equation doesn't exist. That if they are quality and growing, then they will not be available at reasonable prices. But there are times when you get such opportunities, that there is a chink in the armor, that there is a problem which is temporary in that business, because of which that business becomes available at reasonable valuations. That's value investing, buying something that is worth, in our judgment, 100 rupees tomorrow, but is available today at 50 rupees. That differential is what we are looking for in value investing. And growth is a key part of that. Growth is what determines what value a business will have. And really, as a value investor, that's what we are looking for.
Sure, but do you think in country like India, where it's more of growth oriented economy, and sometimes value is considered to be a stock which may be a turnaround story, because each of each of the investor have a different understanding of value investing, so sometimes it is wrongly perceived as well. So my question to you is, when you are looking at buying something worth rupees 100 available at 50, then how would you ensure that you buy good quality, because quality demands premium. If it is Bannerghatta, obviously it may not be that expensive, but if it is MG Road in Bangalore, then obviously it commands premium. So how do you tackle that situation?
No, you're absolutely right. Um, now, what happens is that the premium is something that is commanded, but many times growth is not priced in. Let me give you an example. When we were buyers of Britannia, say in 2014 or thereabouts, the value that the market was ascribing to growth in Britannia company, markets believe that it is going to grow at about 14-15%, while for that growth, the price to earnings multiple that Britannia was getting at that time was about 35 to 36 times. Our belief was that actually this company is going to grow north of 25%. And so, what the market is building in as growth is very conservative as regards the real growth that this company is going to have, because its volumes will grow and its margins will expand for XYZ reasons. And so what looks like 35 times price to earnings is actually 25 times price to earnings. And for a company of this quality, that offers us value, which means that even something that is trading at 35 times price to earnings, if growth is not priced in properly, even that is value. And if a company, on the other hand, is trading at 5 times price to earnings but has zero growth, that is a value trap, because you will not be able to unlock value in a business like this. So for us, value is really growth that is not priced in, and there are multiple opportunities available in the markets at various points in time where this trade-off is favorable to a investor. And so if investors look at it closely, they can find such opportunities. Even in a market like India, while, like you rightly said, India is a growth market, but growth that is not priced in is what we are looking for.
Great, great. So basically, you look for these sort of opportunities where it is not priced in. At the same time, the growth continues to be the main driver or one of the main.
Absolutely.
Absolutely
It is
great.
an absolutely critical component of identifying value. In fact, I should say in the same breath that someone asked Warren Buffett a question that you say you are a value investor, others are growth investors. What is the difference? Warren Buffett's answer was that to classify stocks differently between value and growth is a misnomer. In reality, growth and value are joined at the hip. If there is no growth in a company, then it has no value. And value resides in the growth of a company. So for us, growth is a critical aspect in determining value.
Wow, great. So much to learn. Thank you for sharing it. Well, I had an opportunity to attend Berkshire Hathaway's AGM once. So whenever I get to listen to these statements made by Warren Buffett, Charlie Munger, it really reminds me those days. Anyway, so now, Anshulji, if you could talk to us about how has been your PMS journey at Kotak, and which are the strategies that one investor should look at, and are you deploying money all 100%, or you are staggering the investment? So these are two three questions. If you can talk to us about that.
Sure. So we in Kotak AMC we started our PMS journey in 2012, and so in two portfolios particularly, our flagship portfolio, which is the special situations and value strategy, and our small and mid cap strategy. In these two portfolios, we have a 10-year track record. And the track record is that small and mid cap, being small and mid cap oriented portfolio, has about 18% compounded returns over this period and a 5 to 6% alpha over the index. We have a 5 to 6% alpha in the special situation strategy also, which is a flexi cap sort of or a multi cap sort of a portfolio, and we've generated somewhere close to 15% compounded returns over a 10-year period in this portfolio. And aside from this, we have two sectoral portfolios. One is the pharma and healthcare portfolio, which has a 6-year track record and a 9% compounded alpha over its benchmark. Also, we have a fintech portfolio which has finance and tech companies, and even that portfolio versus Nifty has done quite well in the 3 to 4 years that we have been running this portfolio. And we manage in all somewhere close to 17 to 1800 crore rupees as assets within the PMS. And we've in fact been in the last 3 years amongst the leading performers on the street versus some of our competitors. Why that has been the case is that we have been very disciplined in identifying companies which are sector leaders, and second, companies which are by and large debt free, which have very strong balance sheets. And those balance sheets are combined with strong growth trajectory. For instance, between FY21 and 24, the earnings growth that we anticipate in our portfolio on a compounded basis is somewhere in the region of 25 to 26%, for a price to earnings ratio of only 17 times. Now, what that means is that our PEG ratio is somewhere in the region of 0.6 to zero point 0.7, and that offers our portfolio very attractive dynamics in terms of value unlocking going forward. Finally, before I conclude my point, I'll just say that this is a relatively, if we look at our flagship portfolio, it is a relatively liquid portfolio with roughly 24,000 crore of median market cap. Weighted average market cap is about 50,000 crore. And the portfolio, by virtue of the names that it holds, is very nicely poised to deliver strong returns over the ensuing future also. So that's what I would like to say about our portfolios.
So the Flexi Cap that you run, which is a special situation, right? That's a multi-cap portfolio. So what would be the percentage of large, mid, and small cap in the portfolio, and how frequently you change that?
So we have roughly 36 to 37% large cap, and equivalent amount small cap, but small cap would be large small caps. They won't be the 1,000-2,000 crore market cap companies. They'll be 10,000 to 15,000 crore market cap companies, and the remaining will be mid caps. And we hold some cash. We've been holding 5 to 10% cash since the last few months. And to your other point, that if someone deploys capital today, how is that capital deployed? We deploy that capital in a staggered manner. We don't go in and deploy immediately the entire amount. What we do is that we deploy somewhere close to 40 to 50% in the first week, and the remaining we deploy over a period of time, usually over a month. So that's how we deploy our capital in the portfolios. And of course, there is no hard and fast rule here. We also, depending on the market situation, modulate our deployment of capital.
Question that I keep getting from my investor, that you have mutual fund vertical and versus PMS vertical, and they have been already investing in your mutual fund and made amazing returns in the last decade or so. And in fact, one of your small cap fund itself has ended up delivering 20% kind of CAGR for
Correct.
18 to 20% for 10 long years. So
Correct.
they asked me, why should I consider PMS versus mutual fund? Over to you.
See, the way I try and describe this is that आप किसी शादी में जाते हैं, आप शादी में जाएंगे तो सेरेमनीज के बाद खाना होता है. खाने में थाली जो है वो तो स्टेपल डाइट है, तो म्यूचुअल फंड तो स्टेपल डाइट है. लेकिन उसके बाद आपको ऐसा लगता है कि अभी खाना पूरा हुआ नहीं है, मुझे डेजर्ट भी चाहिए. तो डेजर्ट जो है, जो कि साइड डिश है, वो उसके बिना खाना पूरा नहीं होता है. वो हमारा पीएमएस है या ऑल्टरनेटिव प्रोडक्ट्स है. अब आपने अगर अपना 70-75% पैसा आपने इक्विटीज में डाला हुआ है, और मतलब इक्विटीज मतलब आपने म्यूचुअल फंड्स में डाला हुआ है, तो आप कुछ अमाउंट उस पैसे का ऑल्टरनेट प्रोडक्ट्स में भी डालते हैं, बिकॉज आपको वो you need those characteristics of alternative products also in your portfolio. What are those characteristics? The characteristics are that you have about I mean, it's a concentrated portfolio. Unlike a mutual fund, which is 60, 70 stocks, a PMS is, say, 20 to 25 stocks. And it is more, you can say, customized to your requirement. जैसा आपने मुझसे पूछा कि आप इमीडिएटली डिप्लॉय कर देते हैं कि आप थोड़े टाइम में करते हैं, अब म्यूचुअल फंड में पैसा जाएगा तो वो उसी दिन डिप्लॉय हो जाएगा। हमारे केस में हम उसको मॉड्यूलेट कर सकते हैं, वी कैन डिप्लॉय इट ओवर अ पीरियड ऑफ टाइम, and we can also have certain changes in the differences in the portfolio. Say I had bought 10 years back a Britannia, and that Britannia today is up 5 times. I don't want to buy it for new clients, but I want to hold it for existing clients, because existing clients, the purchase price was far lower. Then that sort of modulation can be done in a PMS, which cannot be done in a mutual fund. So PMS has a different flavor, and it is a different product in comparison to how a mutual fund is run. And some amount of capital, maybe not 100% of your equity capital, but some amount of equity capital must go to PMSs, and it is in a sense diversification of your own asset class. And quality PMSs have done well in the past. They will continue to do well going forward as well.
Sure, I agree with you. In fact, sometimes the data points are a little misleading also. I'm not saying that mutual funds have not delivered return. All I'm saying is, suppose you want to invest for a particular period of time, and you're bullish on the economy, you can design, you can bearish on the economy, you can design your portfolio, customize, do some changes, take some cash call. These sort of things are not available in mutual funds. So I'm not saying mutual fund तो सही है ही है, तो
Hmm.
मतलब पिछले 20 सालों से बहुत अच्छा उन्होंने काम किया है, but at the
Correct.
same time you cannot afford to put all your eggs in one basket.
100%.
To diversify, and I agree with Anshul here, is that when you are looking at specialized or maybe a sort of dish that you like, after your food, then you should have these kind of instruments in your portfolio. और पहले का और अभी का एसेट एलोकेशन में बहुत चेंजेस आए, as we can see, Anshul, already we are ourselves witnessing as a PMS platform, not because we are running a PMS platform, so we are saying mutual fund sahi hai, or we have a lot of respect for mutual fund, but at the same time we see some amount of value migration happening from mutual funds to PMS, especially amongst the HNI investors, when they felt the need of it, that some amount of money that they need it for a particular time, or they're sure about it, they would like to have this invested in a platform like PMS, and then design the way they want to build the portfolio. So it is absolutely must have, especially the alternate investment funds, the way some of the funds are designed, particularly, for example, if you want to take a bet on pharma or a banking plus technology. Now this is a unique concept that you don't get anywhere in the mutual fund.
Correct.
Like you say, see, banking financial is that plays very very important role in any of the developing economy. So that is one, and coupled with technology companies, or maybe like Bajaj Finance, which is tech plus finance. So these sort of combination is very rare to get, and then you should explore these kind of opportunities here. So what I was saying is, what we'll do is we are opening up the forum for Q&A, and there are some questions which has come in. So can I start taking that?
Yes.
Okay.
Yes, Vikas. Sorry.
All right. So the first question is that it comes from Puneet. How does one take factor like Britannia? You gave the example of Britannia, and the promoters were siphoning off 800 crores of shares, so worth shares. So any feedback on that?
See, more times than not, I mean, markets are working on a rate of change. Now, what the promoters or anybody has done in the past, say the management, he's just giving one example, but let's assume that the management is inept. And it is because of that ineptness that the stock is trading at low valuations. If there is a change in management, and from being inept, the management becomes good, then that change will drive the stock price. Similarly, if the market knows that there has been not proper capital allocation in the past, and that is already priced in into the stock. Assuming capital allocation improves going forward, then markets will react favorably to that. And so what is important is that is the leopard changing his spots, or does he have the same spots going forward as well? If he's changing his spots for the better, then that is something that one should be keen to understand, and really to factor in, should be able to factor it in one's calculations. And that will determine whether the stock price moves up or down. I hope I'm able to answer that
Yes,
question.
yes. So the second question is, it comes from Mr. Kumar, Amit Kumar. So he is asking that at a portfolio level, what is your mix like? Where are you overweight? Large cap, mid cap, or small cap?
So, as I had mentioned, we have about 36-37% large cap. And this number used to be under 20% till 6 months back. We have taken it up. We have also moved into sectors which are more, I'd say, defensive in this 6 month period, because that protects downsides or prevents downsides. And remaining, say about 35-36% will be in small caps, but these are small caps which are large small caps. They are sector leaders. For instance, if we own a VIP Industries, it is a small cap company, but it is the leading luggage company in the country. If we own a Century Ply, then it is a small cap company, but it is a leading plywood company in the country with very strong balance sheet. So our endeavor is to own sector leaders, and to be as uh, positioned as well as possible to take care of any volatility in the markets.
The next question is, what sort of churning do you have in your portfolio at an aggregate level?
So, given that the markets are changing so fast, what was relevant at the time of COVID, when people were saying that buy COVID, buy companies which will have a benefit of COVID, to 1 year out, where the market was saying that now that benefit will not be there, look for companies which will play the opening up trade, to today, when the market believes that the opening up trade has played out to some extent, and now this is a time to actually be slightly defensive and to ensure that you retain your profits. This sort of an environment requires some amount of churning in the portfolio, and to that extent, you can imagine about a 30-40% churn ratio is what the portfolio has.
Okay, I think there are no more questions. So, with that, we would like to conclude the session here. And I take this opportunity to thank all the investors who have joined us today on the call. And also, I would like to thank Anshul for taking the time out from his busy schedule and joining in today.
Thanks, Vikas. Was a pleasure. Thank
Thank
you,
you.
everyone, for taking your time out. Thank you. Bye bye.